Afternoon, ladies and gentlemen, and welcome to our second Unlock the Stock event, a monthly session specifically formulated for retail investors to gain access to corporate management and get to know them and their companies better. This event is proudly sponsored by Keyter, an insurance and FX services group. Keyter has made a significant footprint in their niche markets, specifically bloodstock, sport, horse, and game. Keyter has meticulously built the company into being South Africa's leading luxury lifestyle insurer and foreign exchange service provider. Visit their website www.keyter.co.za to meet the team and read more about the services they offer. Our host will be the finance ghost and Mark Tobin from Coffee Microcaps, and they will be facilitating the breakout rooms at the end of the presentation session of this event. We would like to welcome Astral Foods, represented by Schutte, and he is joined by his management team, and Trellidor, represented by Damian, CFO. Damian is on his way to Birmingham, so we appreciate him doing this session from the airport. Before we commence, a couple of housekeeping rules. Each company will do a presentation of 12 minutes each. Thereafter, you will see a button on the bottom of your screen where you can select which breakout room you would like to join to ask questions to management. You are more than welcome to leave the one room and join the other room by making a selection by using the breakaway room function. Please note that you will only be allowed to post your questions by typing them into the chat function at the bottom of your screen. Please also note that this event is being recorded and will be available on Keyter Rech Investor Solutions YouTube channel, as are the past Unlock the Stock events, so be sure and subscribe to this channel. Once in the breakout room, you will see an email address if you would like to be added to that company's distribution list. I now hand you over to Schutte, CEO of Astral.
Thank you, Marlies. Also thanks to Unlock the Stock and Keyter for this opportunity. With me, I've got my executive team, Gary Arnold, Dr. Obed Lukele, Dries Ferreira, and Frans van Heerden, and they will also participate during the presentation at time of the questions and answers. Those of you who don't know Astral, we are a fully integrated poultry business, and Gary will go into the detail of that integration a bit later. Astral just turned 20 years old. We listed on 9 April 2021 on the JSE, and 2001, so 20 years old now at this point in time, and we've been part of the top 100 JSE listed companies for a large period of the past 20 years. Currently, we have over 3,000 shareholders, and we currently represented in 4 Southern African countries as poultry or animal feed producers. We employ approximately 12,500 people, and we own more than 7,000 hectares of agricultural and industrial land. We have approximately 180 agricultural sites. It could be either farms in the breeding part of our business or in the broiler production. We also have 4 poultry processing plants in the main centre, being down in the Cape, 2 up here, Standerton, Olifantsfontein, and then a smaller plant down in KZN. We also have 9 animal feed production units in Southern Africa, and as you know, feed is an essential part of producing chicken. It makes up approximately 65% of our total cost of producing a kilogram of white meat. Therefore, feed production and the nutritional aspects of optimizing our genetic potential is essential to running a well-placed, good positioned and best cost operation in Southern Africa. We also the biggest consumer of yellow maize in Southern Africa, approximately 800,000 tons per annum. So maize prices or raw material prices quite important to our production chain and our cost of production. And soya meal and maize make up about 75% of our total feed ration. We produce about 1.3 million tons of feed through the 9 feed mills in South Africa, supplying approximately 60% of the feed produced goes to in-house businesses, and 40% are supplied to external customers throughout the whole spectrum of animal husbandry: swine, dairy, beef lots, lamb, and some other smaller animal groups or disciplines as well. We are well represented in the centre where the growth in South Africa is, and the only 3 centres that have positive economic growth is the Greater Gauteng area, KZN and Western Cape, and that's exactly where we position. That's also where the bulk of our consumers are. So well positioned, and our focus is around those geographical areas to expand and further integrate our businesses. Gary will talk to you about the integration and the 3 divisions in the Astral Group.
Thank you, Chris. Astral Foods, as a poultry producer, is a fully integrated company comprising 3 divisions. That's the animal feed division. Chris spoken briefly about that. Agriculture, which encompasses or houses all of our farming operations, and then our commercial division, which houses the pork processing plants and all the poultry consumer brands that you would see on the retail in the retail sector on shelf. So Astral, as an integrated producer, owns our own feed operations or manufacturing. We own the breeding of our birds. We farm with the Ross, International Ross, through our 8 genetics. We have 4 generations of birds housed within our operations, right from the grandparent level through to the broiler level. We breed that breeding stock to produce Dale chicks and broilers for rearing. We also sell into the external market hatching eggs and Dale chicks, as well as parent stock. So an integrated business with 3 main divisions. The poultry production chain, we're currently slaughtering 5.8 million broilers a week. So at any one point in time, we have over 40 million birds on the ground that require daily care, hourly care. We feed them, we provide them water, we provide them the right conditions, environmental conditions under which the birds can grow, and that all to produce 5.8 million broilers a week that then go into the South African poultry market.
Over to Dries Ferreira.
Thank you, Chris. Thank you, Gary. Just very briefly, we've got the history of Astral depicted on these graphs going back from date of listing 2001. I think a significant graph depicting the revenue growth, which shows a consistent growth over time, and then obviously flowing into the profits and dividend slides, which reflects Astral's exposure to the commodities pricing that is our main input cost, mainly maize and soy. On the operating profit, you can see the rise and fall of the profit line, which really reflects the push up of the costs of the commodities, and then how we recover that from the market will then increase the profits again. We've maintained over the period a 2 times dividend cover. That's what our stated objective is. And in some cases, in some of the years, depending on affordability, we've been able to beat the 2 times cover and drift down to around 1.8 also in some cases. On the asset side, you can see the assets invested in the group has continuously followed the demand for chicken that we produce, and our installed assets therefore also follow the revenue line. On the cash generation reflects the strong cash conversion of profits, and ultimately that cash is redeployed into the business as capital investment, and we average around 200 to 300 million of capex per annum, as can be seen there, and with a large capex program that was done in recent years on the back of good profits that came through.
Thank you, Dries. Just to look at the prospects or the nearby prospects, some of you would have noticed that on the 2nd of February, we did issue a SENS indicating to the market that for the interim period or up to end March for the first half of our F22 financial period, we expect our headline earnings or earnings to be up by at least 100% on the comparative 6 months. Now, one could say that's significant, but one should remember that the first 6 months of the prior period also included some of the negatives of the harsh lockdown and the impact of COVID on the environment and also on the retail and the QSR markets. Of course, like all businesses, the Russian-Ukraine crisis will have an impact on Astral indirectly, because Ukraine is one of the largest exporters of corn in the world, and them not be able to use their harbors or their ports, and also now difficulty planting the new season will have an impact on the supply, global supply and demand. That will have an impact on prices, and SAFEX are directly coupled to the Chicago Board of Trade price. So we currently negatively impacted by that situation. Then also fuel or energy is Astral's third largest expense line, and with the increase in Brent crude will have a direct impact on our ability to distribute and to manage our inbound and outbound logistics. So that will have an inflationary impact on our margins. And then, of course, both from the raw material and the energy side, it will depend on our ability to then recover that in quite a depressed consumer market. But the first 6 months, as indicated in the sense, looking fairly good. The second 6 months will be slightly more of a challenge with this higher input cost from both energy and maize. The local maize crop looking good. That's our third crop that's looking good, and it's above our local consumption rate. So if we traded fundamentals based on the local situation, our maize price would have been much better, but unfortunately currently linked to global events. This might change in the medium to long-term future if we decouple or detach from Chicago Board of Trade, trading local fundamentals. We could see a positive move for poultry input costs from the raw material side. Then, of course, from a macroeconomic environment, we operate in most of the time in the rural areas, and there is quite a concern about the infrastructure and the decay thereof, and of course the service delivery. And we're quite actively currently pursuing to become self-dependent from both the water and electricity supply point of view, obviously at a bit of a cost in those rural areas. We're also taking the government to task on that, and we currently on the last bullet on that slide have got a court order that requires central government or the president's intervention in Standerton, where our biggest feed mill and processing facility is. Why invest in Astral? I think one should know that poultry is the cheapest source of protein, and it is consumed by all aspects and all spectrums of the South African community, and we're well positioned there to service from the lowest cost product to up into the higher margin value added products. We are in the main centers. Our distribution costs into those are very positive versus some of our competitors. We also, as Gary indicated, make use of the best genetic poultry genetics in the world currently, and that gives us a early start and advantage over our opposition. And we've learned how to farm this bird. Currently, we regard ourselves as the best producers of protein meat in Southern Africa, and that's why we've had the ability to grow both volumes and sales price over the past 5 years in line with inflation. We also have links with international service providers on that side, so both from a nutritional point of view and a procurement of raw materials, we link to some of the best traders and operators in the world. From a brands perspective, we trade mainly with 4 brands. Our frozen brand, Goldie, is regarded as the strongest poultry brand in South Africa. And we also have County Fair as a leading brand in the Southern and Western Cape. People skills, we've got the people to do the job, and hence our claim or that we are regarded as the market leaders in the sector in Southern Africa, and put us in a position to produce the cheapest kilogram of white meat. We did talk about the regional and national footprint. Got feed mills, farming activities and processing plants in the main centre, and that leads obviously to a strong cash flow as Chris described earlier. We don't like gearing. It's a volatile business. We don't like debt, so we've been cash positive for the last 5 years. From a customer perspective, we service the full market spectrum and all the market channels in South Africa, right from vendors into the sophisticated retail and QSR markets. Sorry for that. Just had a piece of chicken. And then from a ESG perspective, we recently got a rating of a score of 66%. It was our first score. And we've got a strong strategy and a future plan to improve on all ESG matters, and it will become part of our strategic focus in the nearby future. That is the presentation from Astral. Back to you, Marlies, and to unlock the stock.
Thank you, Chris and team. I now hand over to Damian Judge, CFO of Trellidor.
Thanks, Marlies, and welcome to everyone for joining us. Before I get started, I just wanted to thank everyone from Unlock the Stock for putting this together. I think it's a wonderful platform, and I look forward to trying to get you to unlock a Trellidor today. You don't get to say that too often. Just to give you a little bit of background of what we do, the traditional Trellidor business was business comprised of the manufacture and export of custom-made custom-made security barriers, and we've got a franchise and distributor network across South Africa, Africa, and internationally. We diversified into the complementary products, including blinds, decorative shutters, and moldings, to support sustainability of the brand in the home and DIY or home improvement sector. So we've been trading for about 45 years, more than 45 years now. We've got what we like to think is fairly strong brands in our market segments. We're represented throughout South Africa, UK, Israel, Europe, USA, and Australia. And we obviously are listed on the main board of the JSE under TRL. We have a little bit of a split, so you can just see a sort of contribution of EBITDA in terms of the segments. We have Trellidor business unit contributing majority of our EBITDA levels, and then Taylor and NMC brands, which were the new acquisitions, just under 40% of our contribution at the EBITDA. I've included just some highlights. We recently released our half-year results. So I've just included some of the salient points to give you an understanding of the financials. Headline earnings per share were 25.4 cents, down a little bit from the previous period. We had some cash generation was 18 million for the 6 months. Revenue was up 1% to 284 million. We had to hold out in declaring a dividend due to a labour court issue, which has been sort of well publicised. And our return on invested capital was at 17%, slightly down from previous year. So just to give some context to the numbers, and I think it's important just to highlight in all three of the business units, from a Trellidor perspective, which is based in Durban, our manufacturing plant is in Phoenix. Unfortunately, we were hit quite badly by the riots in July, and the factory was closed for 7 days. There was no damage to anything, but it did hamper production, obviously. And then in October, we were then hit by the 3-week metal union strike. So that we lost about 28 days of manufacturing time during 6 months, which we equate to about 28,000 man hours, which obviously dented our ability to hit the top line targets. From a Taylor perspective, Taylor imports quite a lot of its product out of the East, and with the logistical challenges they faced, we had quite a few stock issues which hampered capacity and the ability to meet demand. And then the NMC guys, which is focused on the corner scene and skirting business, very focused in DIY and home improvement. They had a nice bump coming out of the lockdown the previous period, but that sort of is normalized to pre-COVID levels now. So that's why they were slightly down. Looking ahead into H2, we've obviously put in place now some steps to mitigate these challenges. So we've invested quite heavily in stock, which we'll get to a little bit more, to try and mitigate the disruptions we've experienced, and a lot of that stuff is in place. And in terms of the wage agreements, we've entered into now a 3-year wage agreement with NUMSA, so that should steady the waters in the coming years. So we do expect a smoother ride into F23, as the guys have already chatted about. Given the war, things are a little bit uncertain. So just a quick overview on historic performance. As you can see, I was highlighted that revenue is up 1% year on year. So if you factor in the challenges that I've just unpacked, it's not a bad result. And that's mainly driven by a couple of key acquisitions. So one of our key strategies that we've unwrapped is buying back a couple of strategic franchises within the main cities. So we've bought back four franchises in Johannesburg. We've got one in Cape Town. We've just newly completed another acquisition of 2 more there, and we've got 3 in Durban. And that's allowed us to get a little bit closer to our consumer, being able to challenge the way things have been done, try new things. And that little business is up 27% year on year from a revenue perspective. And then in the back end of 2020, we purchased the UK franchise from the retiring franchise owner. Quite interesting to make a 30 million plus acquisition over Teams. But yeah, so we completed that deal. Haven't been able to travel, so I'm actually at the airport today on my way there for the first time. Be interesting to see what we bought. But they're up 45% on a like-for-like basis year on year. So 2 strategic acquisitions that really helped contribute and mitigate some of the downside that we've seen in SA over the last couple of months. So overall, which means our HEPS and EPS are down to 17% to 25.4 cents, which has been marginally offset that decline by some buyback of shares. So we, as a business and as a board of directors, believe we're quite undervalued from a share price perspective. So we have been on a program of buyback shares since 2018. So you can see at the bottom of the slide, the weighted average number of shares has decreased steadily over the last few years. We haven't been in the market buying through F22, as we've been focusing some of these inward acquisitions, and the strategy with the share buybacks is to focus on excess cash. Getting to cash, and I thought it's just important to include the slide because for me it's one of the ones that really highlights why Trellidor is such a great investment. It is its cash generation. So you can see over the last few years, even through difficult times in the G20, which is the COVID years, we still had really, really strong cash generation and free cash flow. And that largely has allowed us to execute on a lot of our strategies, from the buyback of the main centers, buying back of shares. That's all come out of excess cash. And then in this year, these last 6 months, you can see things haven't been as prolific on the cash generation. And that's really triggered by the fact that we've been focused on investing in working capital to meet the demands in the market, while trying to mitigate the supply challenges that we're getting out of not only the East, but also Europe. So we think we're in a much stronger place now in H2. We had a lot of stuff on the water that was supposed to land November, December, only started to come in January, February. So it really has hampered our ability to meet demand, and we feel that we're in a good place. So we should start to see that stabilize now through through H2 and into F23. Again, Ukraine, Russia dependent. So in terms of just unpacking our network a little bit, we're represented in 27 countries across the globe. We've got 5 Trellidor owned branches in South Africa, UK and Ghana. We operate with 2 Taylor branches, so based in the Western Cape and Joburg. We've got 54 franchises in South Africa, 3 NMC branches, and then 51 of our 54 franchises are distributing our Taylor products. So this really differentiates us from our competitors. We've got probably the strongest network across South Africa. If you're looking to invest in the security space, it's enabled the Taylor franchise or the Trailer brand, which was very Western Cape focused, has been plugged into the Trellidor franchise, and that's seen steady growth through that network as a nice sort of complementary product to the Trellidor guys. So it really enables us to be geared to service on a national basis a lot stronger than our competitors. Unpacking just a little bit of our products, a lot of you would recognize the traditional sort of diamond-shaped burglar guards or sliding security. So that's sort of synonymous with the Trellidor brand and Peter Rawson standing behind the wrecking ball. But we've also expanded over the last 10 years into the more lifestyle or sort of aesthetically pleasing products, which has also got the security element. So we've got our roller-style range, which is our sort of automatic roller shutters, aluminium-based, high strength, as well as our louver shutters. So your plantation styles louver shutters, aluminium with reinforced steel threaded bars for the security element. We've also got our Cottage Guard window range, one of the strongest sort of burglar guard or window security products you can have. The polycarbonate bars to create that sort of see-through look, as well as then our Clear Guard range, which is great for keeping out not only intruders, but also animals, bugs, snakes, whatever you've got. And it's very aesthetically pleasing for both doors and windows. From a Taylor perspective, a lot more aesthetics, a lot more decorative. They've got a nice extensive range of shutters, as well as blinds. So we've got woven blinds, wooden Venetian blinds, as well as aluminium Venetian blinds. We also have the normal vertical blinds, roller blinds, and then into the NMC products, we've got our corner seam, skirting, polystyrene moldings, and decorative sort of finishes to the home. So we really think from a home improvement space, we've got it well covered. From a window covering, door covering, and then the finishings around these areas of your home. Looking at strategic differentiators, so we've got 2 manufacturing plants, Cape Town and Durban. Everything is very flexible.
So I think we're already out of time for that. So I think if I could ask you if we can now break away to the breakaway rooms, and if you would like to click by joining on the bottom of your screen.
For the Q&A session here. What I will draw people's attention to while we're waiting for Damian to get back online is if anybody has got any further questions for Damian or would like to get on their distribution list for when they're releasing SENS announcements or other investor-related communications, please make note of the email address currently on the screen. And I'm hoping we'll be able to get him back now shortly. Just checking, is he coming to join us? As I said,
Mark, it's Vanessa here. Can you hear me?
I can, yes. Okay.
I've just spoken to Damian. Apparently, it seems like there's a power failure at the airport, so he's just going to find a place that he can connect with. So he's going to connect to us as soon as he can.
Okay, no problem.
Sorry, everyone.
So we will hopefully have Damian back with us momentarily. Just to reiterate what Marley said at the start, If you want to subscribe to the YouTube channel, Keyter Investment Solutions, for this recording and indeed for the previous recording of our first event, the video is up there, and we plan to be doing these roughly on a monthly basis, coming through with 2 companies, probably on the JSE small cap end, at this stage small to mid cap. So I'd suggest subscribing to that. If you can't make the live sessions, hit the bell for notifications of when new content goes up. Generally the content will go up the following day. So if we run this as of Thursday, I'm expecting this video will go live on the YouTube channel on Friday at some stage. And that would be kind of the regular cadence that we will have in terms of the YouTube uploads going forward as well. So let me see, has Damian joined back in? He hasn't, he's still battling at the airport. They're trying to maybe hotspot to get back into this event. Hopefully we don't lose too much time with him in terms of this Q&A session. We'll give him another few minutes here. The joys of doing a live presentation, Vanessa, when load shedding or King Shack International Airport loses all power.
Yeah. I'm wondering if I should get him on the phone again and just let him listen to the recording and you read out the question. Shall I try that?
We can give that a go. Yes, I think.
Okay, I'm going to try and get hold of him again.
Okay, thank
just
you.
A minute.
Just making sure he didn't end up in the other breakout room by mistake. Let me just see. Oh, his name is not listed there. Okay, so he hasn't connected back with us. Apologies for this for anyone who's eager to get questions to Trellidor, and the fact that we lost Damian just with kind of 1 or 2 slides to go in his presentation. But such is the nature of live events sometimes. Hopefully our plan B now, where Vanessa can maybe, even if we can get him just on audio over the phone, perhaps that will work. Sorry, Vanessa, go ahead.
Mark, I've got Damian on my phone.
Excellent.
Can you guys?
He's a little bit faint, so maybe Vanessa, you might have to relay the question to him, or see if we can just up the volume on your phone there.
Okay, Damian, can you hear?
Yeah, I can hear you.
Okay, he's a little bit faint, but I think it's enough that people can hear. Maybe if people want to just at their local computer turn up the volume so that we can hear Damian as best we can. I'm going to kick off the questions just to start the ball rolling, and please, if anybody's got any questions for Damian, to type them into the chat function. Damian, if I can say that last half, was it a case of everything that could go wrong did go wrong, between the riots, hangovers from COVID, restrictions, the strike, and are you looking kind of forward now to kind of a much better half and really putting that last half to bed?
Yeah, Mark, I think you're spot on. I think it is that, exactly that. Everything that could go wrong did go wrong. Having said that, I was quite pleased with the way that the certain elements of the business responded. I mean, like I said, the UK has kicked on quite nicely, and it gives us a bit of a foreign exchange hedge, which we're earning pounds, which we never had before. They've also got a sort of that roller shutter range that they had been manufacturing internally in the UK, which wasn't coming through our Durban factory. So that's managed to kick on, and there's good demand there. So we're getting those volumes in. So that's been really pleasing. The Trellidor business, although really hit hard by those two events, plus COVID, plus some load shedding, has still been solid on cash generation. Demand is still there. So it's just taught us a little bit more about just how robust this little business is. And yes, we're definitely looking forward to a bit more calmer H2. And I think we've got some great foundation just to build on. And as soon as we can see a little bit of support from the market, we'll see some upside. Unfortunately, coupled with that, we did see the share price come under pressure after the results released, which is probably a combination of global factors as well as our own results. But I suppose it makes it a great buy at the moment there.
If we can just stick with the UK business, since you're on the way to the UK business now, when you dig down into the results, I saw, Trellidor UK as a standalone, had pretty good growth. I mean, what's driving that performance? Is it, easing of the COVID-19 restrictions earlier in play in the UK, or pent up demand, or is it simply down to, the product fit for that market is like really resonating with UK consumers?
No, so it's an interesting, I think the dynamic of the UK versus South Africa, it needs to be unpacked. So in South Africa, we're really residential based. I'd say 99% of the business that we do is into your homes, whereas in the UK, it's mainly commercial and mainly one client, that being the Sainsbury's group. So in terms of the growth, it's really been driven out of increased demand from Sainsbury's. They've seen an uptick in demand from their side. They're buying stores. They are taking over existing stores, and there's a whole bunch of reworking and revamping programs underway, and we've had a long relationship. We've actually operated in the UK from the early 2000s, and Sainsbury's has always been a key customer of ours. Following the London riots in 2011, we developed some key products for them. So we've been a long-standing partner. In end of 2021, we were nominated as one of their vendors of the year, which is obviously a nice achievement and to be recognised. So we've got a very strong commercial base in the UK, which now, and the reason for the purchase is that we've seen an opportunity to grow that. It's been really focused on one or two customers. We've done some key work with the London Underground, but now we feel that we've got the right opportunity to grow that sales team and kick on and see some better returns, expanding that customer base, and then starting to dabble a little bit in the residential and see where that side of the market takes us.
And you mentioned supply chain logistics. It's been a theme, right across the market. And I've, heard of companies overstocking. I know you've built up a bit of stock, which has an impact on cash conversion and working capital as a flow on from that. Are you looking to do anything further, or are you thinking you're in a kind of a safe space now in terms of stock levels, be that finished product or raw material?
Yeah, I mean, how much is enough, I think, is the question everyone's trying to figure out, especially when you get the Ukraine situation thrown at you as well. But we believe we've ramped up to where we need to be, so we don't think we're going to keep going. We stabilize. Again, it's two very different markets. On the Trellidor side, we've got a strong relationship with our suppliers, so there's a lot of stock that's kept off balance sheet from a Trellidor perspective, which makes it a lot easier to absorb these pressures. But Taylor, they are directly exposed. So what we've done over the last few months is ramp up. We feel at a good level. We're actually talking about now we can start to normalize our buying, and then just get into a regular trend. So I think safety stocks are in place. So we expect to see working capital stabilize and then turn some of the stock into cash.
Okay, so we should be mindful of working capital swings over the next couple of halves then. Rest of Africa, when I drill down into the result, rest of Africa, kind of did the opposite to the UK, kind of pull back a bit. Do you see that recovering? And, I'd like to get your thoughts on it, the long-term strategic thinking on the rest of Africa business, because we've seen, quite a few JSE companies, closing down their Africa operations, or really kind of pulling back from that, let's move up north kind of strategy that was involved in the last 4 or 5 years. So can you give us a sense on, your thinking on a broader Africa strategy?
Yeah, perfect. So from our side, we've been in Africa for a long time. In terms of the recent sort of performance, I think they've been harder hit from COVID perspective than a South African economy. And I think for me, it's just a middle income issue. I don't think there's a strong middle income sort of base in Africa, and so they're taking a bit longer to come out of it. We still see massive opportunities, so we're not capital heavy invested in Africa. The franchise network allows us to be quite underweight in terms of that investment. So we don't see a need to disinvest at all. We see an opportunity to grow that distribution network a lot more. We are increasing our personnel capacity in South Africa to do more servicing and more direct assistance into those countries, the various countries. So we do really see it as an opportunity. I think as urbanization continues to take place across the major countries, there'll be a need for our product. We've seen on the sort of Indian Ocean islands, with tourism coming back, we're starting to see demand in those areas turning back on. The southern sort of our neighbors, the brand sort of spills over into those countries quite easily, and they're starting to get a bit stronger as tourism again comes up, especially sort of your Botswana areas with the game reserves and that type of thing. So we see it as a real opportunity. The biggest hit on our numbers has been in Ghana, which is our own business, and they've really have taken a knock between COVID and then elections, which always is a bit of a negative in that area. So we expect them to turn back on. So yeah, no, we're quite positive. We put some big names and key experienced personnel behind the team to lead that. So it's a key focus for us to turn Africa back on.
Great. We've got a question in from the audience saying, I don't see a competitive advantage for Trellidor. Barrier to entry seems low to me. It can be difficult, can't be too difficult to make security devices like security gates. Please comment on this and kind of other competitors in the market, and maybe we can take that on a South Africa basis first and then on a UK basis.
So sorry, Mark, just to get confused, so I just want to understand the sort of barriers to entry and what the competitive landscape is.
Yeah, the question is around, there seems low barrier to entry that, making security gates shouldn't be too difficult for anybody. I think they're trying to establish, what sets Trellidor apart from, new competitors coming into the market.
Yeah, I know the barrier to entry, especially on the sort of retractable sort of space, is very low. And it is a very competitive space. So I'm just trying to see, I could maybe get joined back on here.
Okay.
I think I'm back on with you.
So if you want to look at the chat, Damian, I'm trying to see you here. Yes, you are.
Yeah, there we go. Can you hear me?
So if you look at the chat there, we've got a question from Stephen Beatty. If you want to read Stephen's question. Sorry, it might have been difficult to hear me over the...
Yeah, I'm just trying to see if I can see it coming through in the chat. Chat. To everyone, there's more me. I can't see the other chat room, but yeah, so in terms of what sets us apart, okay, so the key thing from a lot of barrier security is that it's not necessarily made to measure, so that you get a standard door that you can then buy off a DIY store or go into an area and then you just make it work into that aperture, whereas us is custom made for a specific for the specific aperture. So it's perfectly fitted into your space, and we make sure that it's as secure as possible. We've also invested a lot in R&D. So in terms of certification, we're the only internationally accredited manufacturing facility for barrier security in South Africa. So we've got international certified products. We needed to get into the London Underground with a very specific spec, and we were one of only 2 companies globally that could meet that spec. So we're very proud of that, and we've got another range of products that we're going through certification now. So yeah, we do have to sell the differentiators in South Africa. It is a very competitive space. But we are the premium brand. We are the one that everyone hangs their quality and their sort of strength against. So it is tough, and that's why we invest quite a lot of money in training, getting our franchise network up to date on all the technologies that we're investing, and making sure that we are moving with the consumers' needs in mind. So yeah, it's definitely challenging. It's not something that's it's not difficult to replicate, but there are a lot that you need to put into thinking when you're actually trying to prevent access into your home or property.
Another question, sales and profitability peaked in 2018. It looks like growth is slowing. Well, I think between 2018 and now, there's kind of 2 years lost to COVID in there, out of the maybe 3 weeks since 2018.
Yeah, so it's spot on. We did have a really good 2018, and what sort of happened since then, if you can remember, we've had a sort of a decline in building spend through 2019, and then obviously into 2020 when the consumer has been under a lot of pressure. So there have been external factors, and then it's also allowed some cheaper product to come into the market, which we're up against at the moment. But what we have seen by investing in our franchises, our own franchises in the main centers, that's seen a kick quite nicely in terms of sales getting back up. So I'll give an example. In Durban, we bought back 3 franchises. They were good, well-performing franchises from what we could see. And within the first year, sales were up 30% with the same people. So what we have seen in through these difficult financial times since sort of 2018 on, small owner managed businesses, which is our franchise network, they come under pressure quicker than the bigger owned businesses. And so by getting these small businesses back together and maybe a bit more scale, it's enabled us to be a lot more responsive to the market and close a lot more deals. So we've seen good growth in our main centers, and that decline has specifically come out of the main centers. Our outlying areas are extremely strong and robust. As a way of example, our largest volume franchise is in Umtata, so it doesn't talk to traffic or LSM data that you'll see. So we have seen the outlying areas really strong. The main centers have struggled, and that's why we look to buy back some of the main center franchises and see if we can just up the ante a little bit more directly with the consumer.
Yeah, let's dig down on that franchise buyback program for a little bit more. Are you kind of happy now with the split between franchises and corporate owned? Or do you feel like you're at the end of that program, or is there still franchises out there that you kind of want to convert back to corporate?
So Mark, so we've gone for a willing buyer, willing seller sort of approach, very strategic to those areas. From a Durban perspective, I think we've got good scale. We've got good operators on either side of us, so we're quite comfortable. We've picked up 2 more, like I said, in Cape Town. So now we've got 3 in Cape Town, which gives us a lot more scale. We only had 1 at the time. We probably would like 1 or 2 more in the Cape area, but again, when the opportunity comes. But I think we're well placed to show that the model works now. We've got 4 in Joburg, 3 in Durban, 3 in Cape Town. And we're starting to see the traction. And yes, if other guys put their hands up or there's an opportunity to buy the other ones, we'll pursue it. But we're not aggressively going out to try and buy back these franchises. Our network is our strength, and we need to encourage and use them as best as possible.
And inbound inquiry from people, wanting to do a franchise. Is there gaps across the country? If you say, I'm surprised to hear you say, Tata is your like biggest volume franchise. So I'm thinking, is Uppington or somewhere Polokwane, are these network expansion opportunities if you can find the right franchisee for those markets?
Yeah, so we are well subscribed across there. So we've got a very strong regional sort of franchise agreement. So the guys have quite expansive regions that they focus in. We don't have any regions that are available at the moment. There are one or two guys in some of the outlying areas that are looking to sell, and there's demand coming in. There are guys looking to get involved and buy them. But yeah, we're very selective. In terms of franchise agreement, we do have first right of refusal, so we make sure that we get the right owner in. We got a very specific model. We like an owner operated guy, so a guy that must do the selling, do part of the installs himself, so he's close to the ground, close to the community. So if the guy's not going to do that, it makes it a bit more challenging, especially in those outlying areas, to get the return that they would look for.
Okay. I just got the notification that this breakout room we're going to end probably in about 20 or 25 seconds. So Damian, thanks for struggling with us and bearing with us. And
so thanks for accommodating me.
Do your questions, and have a safe trip to the UK.
Excellent. Yeah, thanks, Mark, and thanks, Vanessa, for the phone-in support.
Pleasure, Damian. Have a good trip.
Thanks, everyone, and thanks for listening.
Okay, bye.
We're lucky in this room because we know we still have people to talk to. I hope Damian's signal came right there. It's always fun with these online events. But welcome, everyone. Thank you to the Astral team for taking the time today to speak to us and to teach us about your business. I think that's really what this is all about. I see the questions are already coming in. There's no gun shyness going on here, which is lovely to see. So let's start. I mean, we only have X amount of time. Dirk, I'm going to go with your question first. To what extent are you able to hedge the input prices like maize and fuel? I mean, I guess that's one of the biggest questions on everyone's mind, obviously. This is one of the toughest things for Astral, so it was one of my questions as well, so we may as well start there. To what extent can you cushion the impact of these really hectic at times input cost movements? It must be incredibly tough.
Yeah, thank you for the question. Maybe, just to clarify, Astral doesn't use any financial instruments to hedge our coarse grain purchases. We buy delivered contracts, so we buy futures, but they're also delivered on a delivered basis. How we've managed the volatility in the market over the past few months is to stay short in our position. So not to take long positions with uncertain times. That has worked for us in the last few months. So, but in a market where you have increasing global coarse grain prices and which is pulling SAFEX up as well, it's very difficult to take a long-term view on these markets. So at this particular time where we are buying between an old crop and a new crop as well, we haven't actively purchased any maize into the new season, and thereby staying as short as we can without exposing the business to any supply disruption. So really the strategy is decided by our procurement committee, and we then implement that strategy, and that has been to maintain a fairly short position, as short as we can, which is allowed under a board mandate, and just to manage the volatility in our input pricing. Obviously, where opportunity does present itself on a daily basis on SAFEX, if we have a good drop on SAFEX, we will then actively buy, and depending on what pricing levels we see and on what futures months we'll buy then to use. And that's, again, I just need to reiterate, we're buying maize for delivery and future usage. So we're not using any financial instruments to hedge at all.
Thank you very much. So the bankers are not making money here. There's no fancy stuff going on in the background. And I think years of operational experience definitely counts in your favor here. It's part of what makes this business difficult. And that's actually some stuff that I want to touch on before we go to the next few questions. So, the chicken business is not for chickens. That's the point here. It's got strong revenue growth. You've got a population that's growing. I mean, anyone who's seen one of those charts of how the South African population has moved through the LSM curve over the past 20 years, people moving into the middle class, that's all very supportive of your business ultimately, but incredibly erratic operating profits because of the input costs and everything that goes into this. So I think it's really impressive that, I think you mentioned you've been cash positive for the past 5 years. That's not easy in this space. And I think it's great that in your reporting, you put that track record there that shows that revenue chart going backwards and the operating profit. There's certainly no effort made to hide the reality that, some years are fantastic and some years are perhaps not as good. You're dealing with infrastructure challenges, as you've mentioned. I think Steve has written a comment there, mentioning some of those changes and saying that he likes a business with a moat or a competitive advantage. Now, interestingly enough, Steve ends off by saying he doesn't see one for Astral. I beg to differ on that, just based on my own experience in the market, is sometimes a company that operates in a really tough space actually has a moat because it does that. It's not necessarily a business that other people are sort of jumping at the door to run into. Sometimes you can operate in a very attractive industry and you can have competitors coming in the door all the time. So I don't know if there's anything on that you would like to comment on. How do you see your moat and competitive advantage in what is ultimately a very tough industry?
Yeah, of course, it all starts with the genetic material that you deploy, and we've had a long-standing relationship with the best genetic house in the world. The genetics we employ is the Ross 308. It's currently the best performer in the world. Then you have to learn how to feed and farm that bird. And over the past 10 years, we've shifted our focus from just producing chicken and trying to sell it at the best price to really focusing on our production efficiencies. And there's a lot of studies done on South Africa and Astral, and a study by the University of Wageningen in Holland actually indicates that South Africa, and within that Astral as about a third of the market, is one of the top 10 producers in the world. So that is our focus. We want to produce the cheapest kilo of meat and not necessarily want to farm and then go and see what you can fetch for the product in the market. Also, we're not focused on just one market or channel or sector. We service the complete South African available market channels from almost spaza shops right down to the sophisticated retail. Our integration is also a focus point. Everything that we can do and that's under our control, we optimize on a daily basis. We've got a very simple strategy. That's to remain a pure poultry company, not to diversify into anything else, but also continues to produce the cheapest kilogram of protein in the southern tip of Africa. And it seems to date that we are fairly successful with that. Not that it will last forever. We will have to continuously improve on that. And the majority of our capital expenditure is around efficiency improvements. And also, of course, if you're the best producer, best cost producer, it is easier to grow your volumes and to have an impact on the market. We were, for the first half of Astral's lifespan over the past 20 years, we were in the number 2 and 3 position. Without making it a strategic objective, we very quietly and confidently moved into the number 1 spot with approximately between 27 and 30% market share currently, and by far the best cost producer. We will also, in the nearby future, focus on further volume growth. There is now some of the major retail and QSR markets that want to align themselves better with us, and we will focus on that strategy over the next 2 to 3 years. But we've got a great team. We've got what it takes. We've got the genetics. We've got the geographic representation. We've got the people. we have the facilities, and we've got a good footprint in the market. So it is more of the same and just improving and executing our strategy on a daily basis.
Thank you very much. Yeah, I didn't get the good genetics. That's why I'm a ghost. So we know how important that is in the story. But that's a very interesting answer, and I've certainly learned a lot from that as well. I'm going to move on. Salome, you asked about the soft commodities. We've dealt with that. Jason, you asked how the company will keep costs down for the consumer. I think that's now been answered. So moving on to the next question was another one from Salome, is to say, outside of commodities, what do you think the biggest risk is in your business? I think you've touched on a lot of that in your presentation, but if you could pin it down, I mean, is there one that's really top of mind for you?
Besides what we've talked about is the consumer that's not in a good space currently, and then obviously the volatility of input costs. There's one or two other risks. The one is the infrastructure that we touched on of the in the rural areas from a municipal point of view. But Dr. Obed Lukele will also talk about our exposure to bird diseases.
Thank you, Chris. So the biggest risk that we face as well is bird flu, which is also called highly pathogenic avian influenza. So that's an industry risk, and it's actually also a global risk, purely because the disease is spread by wild birds. So in essence, that's what we're facing at the moment. There isn't vaccination approved to prevent that particular disease. So we have very high biosecurity standards on our farms to keep it out. And that is also been confirmed by international experts to look at how we keep the disease out in terms of those biosecurity practices. So those measures are in place. We train the people extensively, and we also incentivize them. So we've definitely grown on that perspective to manage that particular risk.
Just to add on to what Alberto said, we've recently renewed our insurance cover for avian influenza. So Astral does carry insurance cover for this risk. On the back of a visit by a couple of international veterinarians in the past couple of weeks, that cover has again been renewed for this year. So we're confident in that because we have been placed under fairly strict and stringent audits, so that insurers are comfortable to place a cover with us, and that has been approved. So that gives us some insight into the measures that we take to actually curb the spread or keep the disease out of operations, and the tools in your tool bag is good biosecurity practices, and those have been have received a good report by international veterinarians.
Fantastic, thank you. Again, lots of insights there. I'm going to deal with another point from Stephen, just because I think it's top of mind for everyone, and then we'll come back to some of the other questions, and that is this whole point around chicken dumping. It's something we read about a lot as an effect on the South African poultry industry. I think everyone would be interested to just hear some updated comments from you just around that issue.
Yeah, thank you for the question. I mean, it's been very topical over the years. The industry has had a lot to say about it, and because it's a very real threat to the industry. I mean, dumping of poultry products in South Africa has been rife, and we've built a solid case to the international trade and administration and commission to actually impose anti-dumping duties on the unfair trade. In 2020, the industry received news that the most favored nation duty on frozen bone-in products and boneless cuts would be increased from 37 to 62%. That was implemented in March 2020. Amongst other factors, being the outbreak of COVID, the hard lockdown on the back of COVID, which saw the closure of the QSR sector, or your quick service restaurant trade, the weakening exchange rate, poultry prices globally increasing, those all played a role in reducing imports. And we've seen total poultry imports reduce approximately 10% year on year since 2020. But recently in December, the Department of Trade and Industry implemented an anti-dumping duty against Brazil and 3 European countries. That is a provisional duty which will expire in June. It will allow various stakeholders to pass their comments on this duty, but that duty again will serve to protect the South African poultry industry from unfair trade and dumping. The industry has no quarrel with imports, but we do see, and you've seen it recently reported in the press, where chicken and bonded warehouses has moved around, under invoicing and under declaration has been rife. So SARS is working very hard to stamp that out, and then of course the duties will hopefully benefit the industry in the longer term.
Thank you. Yeah, we can only hope for more support from government for you overall across infrastructure, duties, the whole shebang. Moving back to the questions, don't have a lot of time left, so I think let's try and get through all of them if we can. If you could pick something about the business operationally that you'd like to improve on, if I shook you awake in the middle of the night and said, here we go, this is what you should fix, what would that be?
Most probably my golf swing. I'm struggling, and some of the people here, I see them familiar names. My biggest concern currently is my golf swing. Besides that, I think it's our ability to recover input cost in a depressed market. To date, I think some of our investors, if you look at the share price and what has happened over the past 2 weeks, only look at the one side, and that's the input cost side. From an energy perspective and the feed cost. On the other side is our ability to recover that input cost in the market. And as indicated in our sense, we were fairly successful with that in the first 6 months. Now the question will be, and what will keep us awake at night, how are we going to maneuver through the second part of this financial year? And what I can say at this point in time, our finished goods stock levels is the best it's been for a long, long time. So that put us in a position to be a bit stronger on trying to recover the input cost. And to date, I think that the retail and the wholesale understand our predicament, and we get some feedback like rather expensive chicken than no chicken, because the worst thing that can happen in South Africa, if we have got chicken producers closing down because of profitability or lack of profitability, that will have a further negative impact on poultry prices. So I think the key thing is our ability to recover input cost. At this point in time, we are quietly confident that we will be fairly successful in moving this high raw material price over to consumer, and for a period of time or for as long as it's necessary, and then hope for a bit of a pullback on local prices based on local fundamentals. So the key thing is ability to recover input cost.
Thank you very much. David, I think that might answer your question as well. If it doesn't, let me know. Just type something in the comments if you'd like a little bit more clarity on that, because there's a couple of other questions I definitely want to get through as well. And one of them is something I've been asked to ask you, and I can't wait to hear the answer because I'm very curious about this. And that is around free range versus non-free range chicken. So is the free range chicken that we buy in the stores always free range? Does it become a little bit of a gray area between what is and isn't a free range chicken? I mean, how does this work in practice?
Astral in the past also produced free range. We decided about 5 years ago to get out of it. It's very difficult to manage and to maneuver in South Africa, especially with bird flu in 2016, 2017. The reality of free range and the production requirements around that will put you up at a huge risk for avian influenza spread. And we decided on the back of that, we're getting out of it. There is still some people that claim or that do produce free range chicken. It's a very small part of the South African market. It's less than 0.5% of total production. So it is very small, but there is a consumer demand for it. I don't always think that the consumer really understand the dynamics of free range. Free range actually derived from Europeans where they had a problem with caged chickens that produce eggs. Our chickens are all free ranging, but just in a poultry shed with open sides, with mesh, but they're not caged. So it is actually a barn chicken. It walks around in a barn. It's a 80 by 20 meter barn, and they walk freely with water, the right ventilation conditions to grow in. So it is a free range chicken. It is just not leaving the shed or the sides of the shed. And we often try and open the sides of the shed and they don't want to go out. So I think the perception of free range chickens is more around caged birds versus barn birds. Now we already have, all our birds are barn birds. It is in the egg production sector where the big hype is about free ranging birds versus caged birds. So it is a very small part, and it will be very difficult for us with the high AI risk to venture back into that in the short term.
Just to add maybe one point there, farming with free range birds comes at a higher cost of production, and then therefore you have to achieve that premium in the marketplace. So that's something people tend to forget, and you're certainly paying more for something that is perhaps a bit of a misnomer, particularly in the South African context.
Incredibly interesting. Thank you. I've learned a lot today. We've literally got about 2 minutes left, and this question might be too long for that. But with all the difficulties with how challenging this is year on year and how erratic profits are, your CapEx strategy, if you could just quickly touch on how you think about that. How do you sit down and decide, okay, this is a year we invest, or this is a year we pull back, or is it quite consistent?
Yeah, so what do you do with your income? You pay tax, whatever is left, you make a call on what you pay out in dividends. We're a strong cash generator. We talk about a stated strategy of a 2 times cover, and the rest we all invest back in the business. Now, we've got about, let's call it 300 million a year that are standardized CapEx or normalized CapEx. And then when we have bigger projects, we will communicate that to the market, and we will fund it from our own cash flows. So we've recently done about a 1.1 billion rand expansion that's working very well for us. It was, like some of my friends would say, it was frowned upon at the time. It's working very well. As a matter of fact, we're bringing forward the placement of birds to fill up that capacity now. And in the future, most or our thinking around CapEx is a bidding volume growth, generic volume growth, and the other part is efficiency improvements. And that is done well for Astral in the past. If there's possibility of acquisitions, we will look at how to fund those either with whatever sources is available, paper or ring-fence capital, or partly owned cash, partly paper. But that will be something besides our normal CapEx.
Thank you. I think we've got literally 30 seconds to go until this breakout room closes. So I'm just going to use that to thank you again for taking your time today to come and speak to the retail investor community. We're all going to head back to the plenary now, so don't drop off everyone, because there'll obviously be some important announcements about upcoming events and all of that. But to the Astral team, thank you. I've certainly learned a lot today. I'm sure the same is true for everyone on the call, and all the best for the upcoming months and all the challenges. Thank you.
Thank you to everyone that has participated in Unlock the Stock today. I can see that our participation numbers are strong, and a special thank you to Chris and his team, as well as Damian, for making the time in their busy schedules to support this retail investor platform. We hope you've enjoyed this event, and if you'd like to listen to it again, it will be on the Keyter Rech Investor Solutions YouTube channel later this afternoon. Please join us for a closer look at Bell Equipment on 31 March at 12 o'clock, which will be a special event, and for next month's Unlock the Stock event on Tuesday 14 April at 12 o'clock, with impact on closing the loop in terms of product innovation and TWK, Are You Missing the Wood from the Trees? Goodbye.